Back, economic luminaries like former Treasury boss Ken Henry and the chair of the Murray Inquiry into the financial system, David Murray, have argued that Australian investors are too long shares and too short bonds. So our bond education program continues with none other than the CEO of FIIG, Mark Paton. How are you, mate?
Good, Peter.
It's good pulling in the boss to do an education program. And it's not like you want to talk about infrastructure bonds, right?
Correct.
So why are these are sort of bonds you think that people in self-managed super funds would be interested in?
Well, generally, I think so. That's right. Investors that are invested in cash and are looking for better yields. One step to the right of cash is on the left and equities on the right. Is good quality investment grade issuers that give you a very stable income stream and a very stable capital base, and that's infrastructure bonds.
Okay. A lot of people listen to this, investment grade. This is not terminology that a lot of people understand. What is investment grade?
So investment grade is a professional markets term to say that the companies have been rated by the credit agencies like Standard & Poor's and Moody's, and they put a line through the sort of rating classes at what's called BBB-, and that's where the investment grade ratings cap out. So anything that's BBB- or above is classed as investment grade, which means the big investment funds can include them in their investment portfolios and within their mandates.
Okay, so if it gets BBB-, funds that have quite tight controls over them can buy these ones.
Correct.
Okay. The best ones for them, of course, would be government bonds because they're AAA,
Correct.
unless they're Greek ones.
Yeah.
They've improved, haven't they?
A little bit.
Yeah. But okay, so what kind of companies are there? Well-known companies that have.
Well, generally speaking, as you said, Commonwealth bonds, semi-government bonds, and in some of the big financial institutions are AA or AA- rated. But then you come down into very large corporations that have investment-grade credit ratings. But generally speaking, most of the infrastructure bonds that are issued in the market by the big infrastructure assets are investment grade rated. We can talk about some of those specifically. Okay,
well, why don't you give us one so people can understand, and I'll ask you what it's paying, so people are always going to benchmark these alternatives to what they get in term deposits and what they can get as a dividend yield from a safe company and whatever.
I think the starting point is, if you're looking for more yield, in bonds there's three things you can do. You can either go further down the capital structure from senior secured to an unsecured position in the debt ranking.
That's for thrill seekers?
Well, that's for those that want to take more risk in the capital structure. You can find less quality issuers, so you can go into sub-investment grade rated issuers, and that will means you're taking more risks.
What kind of interest rates are we talking about?
Bonds generally, in our world, rank start about the 5.5% and go through to about 9.5%.
Okay.
But then the third way, and this is what we would talk about when we come to infrastructure bonds, is you can stay with very good quality investment grade issuers. You can stay at the highest level of the debt structure, but you can go out longer term. And so infrastructure assets, generally speaking, are very long-term assets. So some examples in the fixed and floating rate bonds are Adani Abbott Point, which is a coal terminal handler, the Dalrymple Bay Coal Terminal, which is in Mackay, and also the Dampier-Bunbury gas pipeline. So all of those assets have very long concessions.
What concessions? What do you mean by that?
It means the contract that they get paid under. So if you're a coal handle determiner, the person that you're getting paid for is usually one of the big coal miners. So the coal miners are taking all the price risk on coal and the ups and downs of the coal market, but the coal handler gets paid no matter how much coal goes through their terminal and no matter how much the coal price moves. So they will often have a 10, 15 or 20-year contract to take the coal, take it to the point where the ships come and take it away to go overseas or elsewhere in the country. And so that concession is very long term. It usually has an inflation index attached to it, so you get the set rate when the contract is struck, and then the fee goes up every year based on, or pegged to inflation, which means that the bonds often get issued with an inflation link connected to them, which means that the value of the bond goes up each year at the same rate that inflation goes up. So investors get to invest in their debt, get a good coupon on the way through, but they also get to hedge their investment against inflation.
Okay, and so the Adani one, for example, what's the interest rate on that bond?
So Adani is 6.1%, so we recently arranged an issue under their bond program, $100 million for 6 years, and that was a 6.1% coupon, and that's a senior secured fixed rate bond.
Okay. Sydney Airport, what's going on there?
So Sydney Airport has two bonds on issue, one that matures in 2020 and one that matures in 2030. Their bonds are inflation linked. So the way the airport makes its money is it has contracts obviously with all of the airlines that land there.
It's money for jam, isn't it?
Well, 40% of the revenues come from airplanes landing, and the other 60% come from their retail concessions and car park.
Yeah, money for jam. It's a car park.
They probably sell jam in some of their shops there.
They do too.
And so, you know, they're very long-term bonds. And again, you know, I think when we think about these long-term assets, they're very liquid. So whilst they do have a long-term fixed maturity to them, if investors want to sell some of those bonds on the way through their life, there's a very deep and liquid market for them to
So let's take Sydney Airport. What kind of return are we getting there, do you know?
Sydney Airport today, 6.75% for 2030.
OK, that's the long one.
Yeah.
But you're saying that if you're fed up by 2021, it's highly likely you can put that bond in the market.
If you buy 50,000, well, you can buy those bonds in $10,000 increments. Yep. But if you buy $50,000 worth and tomorrow you want to sell $10,000 of them to go and do something else, you can sell tomorrow into a very deep liquid over-the-counter market.
OK. You might take a little bit less than what you expect if you held it to maturity.
Not with those sorts of bonds. They're very, very capital stable. The bond, once you buy the bond, if you buy the bond at the point of issuance, if you hold it to maturity, you'll get the face value of the bond back at maturity. If you buy it through the life, the price of it is affected by whatever the interest rates are. But with infrastructure bonds, generally speaking, because they have very strong credit credentials, because their income streams are all mapped out and modelled for the life of the bond, there's very little volatility in those bonds.
What about a second airport? How's that going to affect the Sydney Airport bond, do you think?
I don't think it'll affect the bond at all. And in fact, I don't think it'll affect Sydney Airport at all. I think it's a 10-year program to build this airport. Construction is going to start in a couple of years' time.
And it'll still be the number one airport in Sydney.
The demographics of Sydney are expanding significantly, and the airport will eventually get to a point where it just won't be able to cope effectively. Like, you know, in London with Heathrow, they've built 3 major airports around the side of it, and the dynamics of Heathrow have never really changed. Those people that need to get close to a CBD city fly into the CBD airport. Sydney Airport will always be that airport. I think, you know, one of the sort of interesting factors was that Sydney Airport Corporation themselves indicated they probably would like to have a piece of the Badgerys Creek Airport. So it probably tells you that the financials of that are going to be quite...
Do you think Max will be pushing enough to get that kind of... Don't answer that question.
Thanks for letting me on.
One last question. You mentioned inflation indexing. Yeah. So if there was 6.75...
On the Sydney Airport one.
So are you saying that the actual interest rate gets affected by the inflation?
No. So what happens with an inflation-linked bond is the coupon is set for the life, generally speaking, the coupon is set for the life of the bond. Or the coupon means the interest rate that you get paid. And then as inflation is set each year, the capital value of your bond is indexed up by that inflation amount. So what happens is at maturity or whenever you sell the bond revalues up relative to the amount of inflation, and then you're getting that coupon paid against a rising capital base. So let's say you bought the bond at $100 and you're getting 6%. The next year, if inflation goes up by 2%, your 6% coupon is paid on $102 all the way through the life of the bond.
Good explanation. You can come back.
Great, thanks for having me.
Mark, good to see you, mate. Thanks very much. Now let's go to Kate.